It's going to be a slow start to the week with the markets closed on Monday for President's Day, but then things should start picking up. Wednesday, of course, we're going to have the Fed minutes. Then on Thursday, we're going to get jobless claims, initial continuing claims. Friday is going to be a little more interesting because we're going to get flash PMI data from S&P Global. And then, of course, on Friday, we're also going to get the final reads for University of Michigan for February. Basically, what we're going to be paying attention to here, again, are these inflation expectations because these numbers, they went up quite a bit in the preliminary readings. And then, of course, we're also going to start getting some regional Fed data, and those are really important as well because they give us a lot of insights in terms of what's happening in the labor market and inflation as well. So those are important things to pay attention to. But first, we'll take a look at what happened the last 2 days of the week with, basically interest rates coming down on Thursday and Friday following that PPI report. We had a hot CPI reading, and PPI came in a little bit cooler. There were some pretty big revisions, though. But basically, everyone kind of looks through the PPI report and takes out the parts that go in the PCE. And, I put this chart together earlier in the week and I had shared it in my blog. I had shared it with my members. But basically, if you look at the data points that are in the PPI report that go into PCE, airline passenger service fares were down. Portfolio management fees were weaker than last month. Physician care was negative. Home health and hospice care was weaker than December. Hospital outpatient care weaker than December. Hospital inpatient care weaker than December, and nursing home care was weaker than December. So everyone's expectations for core PCE went up following the CPI report, and then following the PPI report and seeing those numbers, core expectations for core PCE came back down again. These data points are all very, they're all over the place, and I think what really matters is the broader trends that we're seeing. And there's lots of trends that say the market is saying that inflation is going to be around 3% for the bulk of this year. In fact, the most obvious place that we can start with and look at is where inflation swaps are. 1 and 2 year inflation swaps actually broke out pretty meaningfully this week. The blue line being the 1 year inflation swap and the white line being the 2 year. And they had really been consolidating for some time, especially at some of these higher ranges. And you can see clearly on the first week of February and late last week, we saw clear breakouts in these inflation expectations. And they're really, at a point where we could really start seeing them move higher depending on how the data continues to play out. Even when you throw in a 5 year swap, that also is showing us that there is this belief that inflation is going to be here for some time longer. Here you can see the 5 year swap. That's also been moving higher as well. And it's pretty close to, breaking out above these tops that have been in place now for some time. And when we look at the monthly view of where interest rate swaps are pricing for the months ahead. So the way inflation swaps work is that they work with a lag. And you can see the time of execution on the trade. And then, of course, you can see the expiration date of the contract. And there's a 3-month lag. So a May contract represents an expiration date that's in February. And you can clearly see that February now is trading around 290. When we got to August, which is going to be representative of a May reading, that's pricing right now around 270. But now notice when we go out to October, which is going to be the equivalent of a July contract, that's trading back up to 3%. August, which is representative of May, is trading back at 270. September, which is representative of June, is trading almost at 3%. And that's all we have, at least for Friday's trade dates. So what this is showing us is that basically the market thinks that inflation is going to fluctuate between, call it 2.7 to 3%. Between now and September. And if we include where 1 year inflation swaps are trading, what basically the market is suggesting is that inflation is going to be around 3% for most of this year. And you can see those expectations, more importantly, have been rising. So I think that this idea that the PPI number all of a sudden made things better. It may have made things a little bit better for 1 month in core PCE. We don't really know what the data is at this point. But what this market is basically pricing in right now is higher inflation this year, somewhere around 3%. Now, look, we're basing this off of what the market is saying. This is an opinion. This is what the market is telling us where it thinks inflation's going to be. And that's what really matters here. Now, the market obviously is free to change its mind. But if we're trying to form our own opinions based on where the market is trading, then if we are to assume that inflation is going to remain sticky and it's going to remain around this 3%, then we can start thinking about what it means for where 10-year rates may be going forward. And historically, when you look at 10-year Treasury rates, they've tended to trade with the direction of inflation swaps. Now, it's not a perfect relationship, but you can certainly see in more recent times that has been the case. And one would think that if, with inflation swaps moving higher, the move down in interest rates we've seen over the last 2 days isn't really likely to persist for very long. And it's more likely than not that if inflation expectations continue rising, that you're going to see 10-year rates begin to move higher again. Now, obviously, if we start seeing inflation swaps trading lower and those values start coming down, then you have to start changing your mind about where interest rates may go. But right now, the general trend is telling us that right now inflation expectations are still rising. They may continue to rise. I think a lot of that's going to be dependent on other things as well. We've talked a lot this week in my free blog about copper prices, which have obviously surged quite a bit. Now, they did have a pretty big pullback on Friday, but you can see this is a major area of importance around 470 or so, because if copper really is able to continue to rise here and push towards 5%, then that's obviously going to be something that helps to pull inflation expectations higher again. Now, mind you, this is also happening at a time where oil really is not participating in anything. And so, again, the question for oil really becomes, are we in some sort of breakout where we're going to see oil really begin to rise? It had looked like there was maybe that was going to happen earlier when we got above this level here, but now we've pulled back. But again, we're sitting right around the 78 to 61.8% retracements levels. So we're going to want to watch $70 a barrel. I think it's very important. If we were to break 70, then you're probably talking going back into the low to mid 60s. If we can manage to hold the $70 a barrel area, then I think it's because we're probably starting to change the direction of the trend, and we're likely to start seeing oil maybe going higher. And it's really the same thing when it comes to gasoline. You can see that gasoline prices have slowly been kind of trending higher as well. But more importantly, again, when you look at gasoline, we really haven't done much of anything since the summer months. So my expectation, again, is if we start seeing oil rising and gasoline rising, and on top of it, if you have things like copper rising, that's going to really start pushing up rates, because that's going to start pushing up inflation expectations. So I think that this 1 or 2 day movement we've seen in 10-year rates is probably more likely than not part of just positioning in the marketplace, where everyone may have been looking for a hotter PPI or maybe strong retail sales, and we didn't get those. So everyone who was short short bonds looking for rates to go higher didn't get that. They have to come in and close out their positions, and they kind of change things around based on that. And when we look at the equity markets, I know everyone likes to look at the equity market. There's a bunch of things that could be happening here. First of all, we're going into option expiration. We know there's a large buildup of gamma around 6,100 on the S&P. That's been sort of acting as resistance. And then we have another big gamma level, which is pretty huge, at the 6,000 level, which is also potentially going to act as a magnet this week as we go into OPEX on Friday. So I don't know if this week is going to be the week that you're going to see the S&P really break out. I mean, you can certainly make a case and say that there's a Bollinger Band. We're hitting that upper end of the Bollinger Band. The RSI is coming back down again. But, again, if you can get above this 61.25 area and you can really get some escape velocity, that would obviously change things. But that's going to also, I think the options market is going to play heavily into that. And you would really need to see, option positioning beginning to shift higher. And I just don't know that you're going to get that this week, with it being a short week and with OPEX on Friday. And the other thing that I think is important too is, look at where implied volatility is. Basically since the beginning of the new year, you haven't really seen the VIX drop much below this 14.5 to 14 level. I'm not really sure that you're going to get it to come below. I think things have changed a little bit from political landscape, it just seems like the news flow is certainly having a bigger effect on markets, and that may very well keep implied volatility a little bit bid. I mean, you also have the VIX 1-day, which is trading around 11.5, so maybe that opens around 9 on Tuesday, and that results in a little bit of a rally Tuesday or so. But ultimately speaking, you're sort of at very low levels on implied volatility. You're at a very low level on the 1-month implied correlation index. We had come up, and now we're starting to come down again. And so that also makes it hard to imagine that you're going to see a meaningful move in the market, given where implied correlations are and where implied volatility is. You're going to really need to see those start coming down to see a significant move higher in the equity prices. So I think, the equity market, I'm still in this mindset that the equity market is still kind of range bound for now in this 5,900 to 6,100 area. And I still am of the mindset that I think interest rates on the back of the curve are likely to continue to move higher, and that's largely going to be driven by inflation expectations, which may very well be driven higher by things like copper and oil and gasoline, based on what we're seeing right now. But anyway, I hope you enjoyed this video. Please remember to share it with your friends and subscribe to this channel. We'll see you during the week. Bye.